Hi, happy Monday. I hope everyone had a wonderful weekend and a happy Mother's Day to all the mothers, whether it's human or fur babies. And we're really excited today. We're going to be talking about types of financial accounts and how to use them. I'm Kelly Snodgras. This is Chris Sumner. We're with RS Financial Group, and we are excited to share our weekly series on financial wellness. So,
quick disclosure for those of you that can't see it on your screen on the presentation, investment services offered through Virtue Capital Management, LLC, RS Financial Group, LLC, and Virtue Capital Management are independent of one another. Thank you, Kelly.
All right. So the ground to cover today, we are going to talk about our typical bank accounts and retirement accounts, as well as brokerage accounts and annuities. And if you're following us on Facebook, we're just going to be kind of live and talking. We are also recording this on Zoom to upload to our YouTube channel, and the Zoom and the YouTube will contain our PowerPoint presentation. So if you're interested in checking that out, then feel free to hop over there. Okay, so we're going to start out with your typical bank accounts. And we have got, that's the ground we covered. Yes, typical bank accounts. So we've got checking accounts and interest checking. We've got savings accounts, money market accounts, and CDs, which are not music CDs. These are certificates of deposit. So we're going to start with the typical bank accounts, the checking accounts. All of the bank accounts are going to be, these are going to be accounts you can find at your local banks. They're all going to be the FDIC insured bank accounts. So the FDIC is the Federal Deposit Insurance Corporation, and they were founded back, it is independent of the government, but they were founded back when lots of banks failed in the 20s and the 30s. And since they have been founded, banks, there's been nobody's lost any money. So that's why it's important when you're looking at a bank to see that it's FDIC insured. Now, you're going to find checking accounts there. These can be free checking or interest checking. These are going to be a transactional account. So this is going to be where you pay your bills from, you deposit your paycheck or most of your paycheck. You'll be using maybe a debit card for your shopping. And then as well as electronically or with checks, you can pay your bills or other people with this account. Now, some places charge fees, some places do not. So local banks, a lot of times they will have free checking. And just depending on what's important to you in a checking account, that you can decide, is it important to pay a fee or not. Now, interest checkings, those are typically going to earn a small amount of interest. They're going to require typically a minimum balance, and if you drop below that minimum balance, then you're going to be dinged with a fee. There's going to be savings accounts, which always a great idea with a kid. Start them out with a savings account, get them excited about savings, going to the bank. This is going to be, there are limits on a savings account because they're basically used for savings. So you cannot pay your bills out of there. There's going to be transaction limits as well as minimum balance limits. And you're typically dinged with a fee if you drop below those. So there's also going to be a money market account, which is typically for if you've got more money than a few $1,000s that you're looking to invest in a bank, you may put this in a money market account. Some other types of companies have money markets as well. And you're just going to earn typically a little bit more interest, but like a savings account, it is going to have some transaction limits as well.
And these days, they're not extremely useful. So just money markets pay very little interest. But I like how you did this, Kelly. You listed out the checking accounts all the way to the CDs. As far as for you on Zoom, you see the liquidity at the top. Like she said, very important to have all that liquidity down to the bottom of very long-term holding, as far as like 6 months to a year. So just wanted to throw that.
Oh, yes, thank you. Yes, with the CDs, typically you're going to give the bank or whoever X number of dollars for a certain amount of time and a certain interest rate. So if you, like the liquidity he was talking about, if you know you're going to need that money in 6 months, you wouldn't want to put it in a year CD because then you would end up paying a penalty. So those are most of the typical accounts that you would find at your bank. And we are going to move on to types of retirement accounts. Most everyone is familiar with the 401k, 403b, and IRA, which is an individual retirement account. We'll start with the 401k and 403b. And let's see, so 401k is typically offered at your place of employment, and 403bs are as well, but these are going to be for nonprofit companies, as well as typically teachers have the 403b. So they are going to be something, typically this is taken out of your paycheck and put straight into the company sponsored plan, and you have a small amount of choices within that retirement plan to invest your money. And the same with the 403b. The difference is the 401ks for for-profit companies. And then there are
also 457s and things. Those we don't run into those too often. So
okay.
Click.
So types of IRAs. We have the rollover, the simple, traditional, Roth, SEP, and HSA, which the HSA is not necessarily an IRA, but we'll kind of talk to that. Some people feel that that's a very important tool for them.
Still qualified funds.
Yes.
So yeah, that's why it's listed.
So we'll start with the rollover IRA. Typically, when you leave a company and you have 401k there, you're going to want to take control of those funds and roll that over into an IRA. So you're going to gain control. Since you're gaining control, you're going to have more options and possibly less fees. And then you're going to be able to, if you have other retirement accounts, if you move those all to one place, you're going to be able to review all of those together. And next we have the simple IRA. This is not used quite as much as it used to, but this allows employers with less than 100 employees to set up IRAs with less paperwork. So we'll move on to the traditional IRA. And this is, when people say IRA, this is typically what they're, most people have a traditional, some people have Roth, but if they just say IRA, typically they're talking about the traditional IRA. It's the most common. You can possibly get a tax deduction for contributing, and the excuse me, these earnings are going to be taxed at withdrawal.
Can I say something about the traditional? So I want to mention also all of these numbers that we're throwing out there: 401k, 457, 403b, IRA, traditional IRA. These are tax designations. I think this would help to clear up. Sometimes a lot of people have the confusion of not understanding. Well, I have an IRA. Well, an IRA just is a tax designation, and you can have 50 different types of vehicles that you place that IRA in. So where you invest your money and how you set your investments inside of an account is a lot different than just saying it's an IRA. So there are many different vehicles that you can actually place that IRA in. So I just wanted to make sure that was.
Sure. So, excuse me, I'm sorry. We've got spring in Memphis and Allergy City. So what he's talking about on the vehicles, meaning you could have a traditional IRA sitting in a savings type account, or sitting in a CD, or sitting in a brokerage account, or an annuity. So it is a designation like you mentioned, and you can put it in a different type of vehicle. So, and that's with basically any of the IRAs. You could set them in whatever type of vehicle that you want. And we've got the Roth IRA, and there's actually no tax deduction for this contribution, but this is also an important tool because your money's going to grow tax-free, and you're not going to pay, I did forget to mention this. I'll go back to this one second for the traditional, but your money's going to grow tax-free, and when you take withdrawals, you're not going to pay taxes on that.
And you actually have access to your principal prior to 59 and a half, which is a little bit different than the limitations on the IRA. I think that's what you're about to mention. The traditional, you are penalized for pulling out before 59 and a half. With a Roth, only earnings are penalized prior to 59 and a half. None of the earnings are ever taxed, and you can access your Roth IRA when you're 35, 40, 45. So there is a lot more flexibility with the Roth IRA. Big fan of Roth IRAs. Once again, very important. Roth IRA is just the tax designation. It's important what you actually place your money into. And that's where we come in to make sure that it is suitable, that what we offer, what you place your money inside of.
Yes. Yes. And with the traditional, what I'd miss is at 70 and a half, you do have to start making withdrawals. And there's the limitation. So you're penalized pretty steep amount if you do take that money out prior to the required age.
Which is, it goes back to what you said a minute ago, why it's important to roll your money over, is because you don't want 3 people to have control of those accounts.
Right.
You want to have just yourself, and then you're told what to do by the IRS versus leaving it with a company and the IRS and the limitations set up yourself. So.
Yes. So next, do you have a problem making too much money? Wouldn't we all love that? Anyway, so if you do, then a Roth or traditional might not be the best option for you. A SEP or a self-employed pension may be a better solution for your investing needs. So it's, go ahead.
No, go ahead. I was going to say the same thing once again, just a tax designation.
Yes.
So then there are many options for your investment.
Yes, still consider different vehicles, but it's the designation. And with the SEP, if you are making too much money, then you can actually contribute to this a much higher contribution. There are limits for the Roth and the traditional and the amount of money that you can not only make annually, but how much you can actually put into there. The contribution limit on a SEP is much higher, and it actually the dollar amount or a percentage of your income.
Yeah, 10 times higher.
Yes.
The contribution limit, 10 times higher than the Roth and the traditional IRA per year.
Yes, so that might be an option for self-employed people that are bringing in too much money.
Which I think we're talking to some self-employed.
Yes, we are. Definitely. And then the health savings account, which I am going to let Chris talk a little bit about that.
The health savings account is still considered qualified, meaning that you can contribute. Cash is the only way you can contribute to it, number one. But you can roll over cash from another IRA, one-time lump sum or annually. Now, what do I mean by qualified funds? Qualified funds are funds that are still qualified for taxation. So if you do roll them out of the HSA, obviously you will have a tax implication there. And there are limits to how much money you can put in the HSA a year. There are also limitations to what type of insurance that is secondary or primary when you're using your HSA. So just ask your current advisor or feel free to give us a call and we can meet and discuss.
And a couple little facts that I thought were interesting, a lot of people might not know, is your children, like we talked about, setting up a savings account for your children, kids that are under 18 that actually have earned income, so maybe they have already started that part-time job, they can start with their retirement plan now. So they can contribute to an individual retirement account, an IRA, and we all know the younger you start, the more money gets put in there, and you don't have so much to catch up on the back end. And if you're a stay-at-home parent or a stay-at-home spouse and you don't have earned income, you can still open an IRA as well. And if you are over 50, you actually can contribute $1,000 more a year to help you catch up. And I'm going to turn over the brokerage accounts and the annuities to Chris.
All righty. So on a brokerage account, some important things to understand. You have discretionary and non-discretionary. When I say the word brokerage account, that means that it is an account that's set up to hold securities, to hold debt, to hold your Edward Jones, your Fidelities, your TD Ameritrades, your Pershings. your 403Bs and 401Ks are all within a brokerage account that works the same way.
Stocks and bonds.
Stocks and bonds, correct. Bonds being debt, stocks being securities. So in a situation where you're an individual directing your own sales, that would be a non-discretionary. So the custodian would purchase, you would open the account and you make the trades, and it's under your discretion what you do with that account. Now there are fees associated with that. Some are higher, some are lower. And also you are managing your own risk, which TD Ameritrade is one of my favorite. It offers you tools to do so. So if you do like to do your own trading, that's a good place to do it. There are also other accounts that you can open, which allow you to either have a financial advisor purchase securities or offer securities for you on a commissionable basis. I prefer an account called a wrap or managed or build account. This account actually affords the advisor and the management company that he or she chooses for his or her client to make trades on your behalf. Now, what does this do for you? This offers you the ability to take the emotion out of your investing, put a plan together, and then you go forward with a plan where no emotion comes into play as far as you making trades and fearfully changing your accounts. So within those accounts, there are no trading costs. There are no custodial fees other than what you pay within the management fee. So for instance, 700 or 100 trades in a year could cost you $800 at $8 a trade, and then a custodial fee versus what's called a wrap account, where you can make 100 trades that doesn't cost you a thing for their trades each day. Right, every day.
If needed.
Yeah, so I'm a big fan of the managed fee-based planning. Now, real quick, I know we're running up on a time limit here, and if you have any questions, I think we mentioned, please type them in on our Zoom audience and or Facebook, and we'll be sure to answer those questions. Quickly, annuities. Annuities get a bad rap, folks. Do not listen to the hype. All annuities are not bad. Some annuities are horrible. For instance, it's just like a car. If I need to get from point A to point B, and some individual comes by and offers me something just to do those things, but it's a motorcycle, and I really needed a minivan, that's
For
where
the
you
family.
right, for the family, and I have to put them all in the back of the motorcycle I just purchased. Same thing with annuities. Annuities are built on a chassis. There are also two different types that I want to discuss today for this discussion. There are variable annuities and fixed annuities. Variable annuities are the ones that have caused most of the uproar in the recent years, due to the fact that in a variable annuity, you as the account holder take all of the risk. In a fixed annuity, the insurance company takes the risk. So if we as advisors can do the same things for our clients that we can with a fixed annuity that we can do with a variable annuity, it's wise to do that. Now, within the fixed side of variable annuities, there are multi-year guaranteed annuities, which are your 5-year, 5% or 3%, 3.5%, 7-year, 10-year, 3-year. So every year you get the same amount of interest agreed upon in the contract. All annuities are deferred. Single premium deferred annuity would be an annuity that you purchase a premium and defer it for a certain amount of time to pay an income to yourself for the rest of your life. An immediate annuity starts that immediately. A deferred annuity starts that after 12 months. My favorite type of annuity is a fixed indexed annuity, also known as an equity indexed annuity. All of those things wrapped into one, the benefit of earning decent interest, the liquidity needs, different types of investment, safety. But the key is there that the insurance company takes all the risk on that annuity. And once again, can fit into all those tax designations. So the account is actually the tax designation. The vehicle, it would be the annuity in that situation. So there you go.
Thank you. All right. So does anybody have any questions? If so, then please type those in. And
got one question. How much do I need to start a retirement account? Well, that depends depends on how you start it. The brokerage account, you can start that with as little as $100 on your own. In a managed account, there are some minimums just due to the fact that you need to have enough money to cover the management style of the company that you choose to manage your money. Annuities, a lot of them are $5,000. Those accounts are $5,000. A bank account, $100 minimum. But then again, anything is better than nothing. Half a hog is better than no hog at all. So get started.
Saving.
Put as much in as you can. It's amazing, $20 a month, what that will do for you over a 10-year period.
Definitely. Well, we thank everyone for joining us today. If you have any questions, please give us a call, 901-312-1630, or you can visit our website. It's rsfinancialgroup.com, and you can just take a visit, see what all we do, how we can help you, and we would love to hear any feedback, positive, negative. We are having a great time with these weekly shows and just want to make sure that they benefit you. So let us know what we can do better, what you'd like to know. Next week is credit. So how to use credit, how to not use credit, and how to help yourself if you've gotten into a not so great credit situation.
And if you are one of our viewers, then we offer a free consultation. So feel free to sign up for that. I want to thank Shannon Massey. Thank you, Shannon, again this week for letting us speak. If there are no other questions, have a great rest of your week.
Thank you.